Welcome to our panel discussion, and thank you so much for all the questions you've sent through. We will try and answer as many of them as we can, but if we don't get to your question, we're going to collate the answers and email it to you. Your Old Mutual Investment Group client manager and your wealth account manager will assist with that. We also want to welcome Peter Brook, Portfolio Manager in Macro Solutions, to our panel. And my first question is going to Peter. Why are most Regulation 28 multi-asset funds still at maximum global allowance?
I think because the managers are lazy. Look, in terms of active asset allocation, there was an opportunity when the Rand blew out to bring money back. And obviously, when the Rand weakens, your proportion offshore grows. So it's even higher than the 30%. And then you can bring that back. So we actually very actively bought back. So some of the funds, you take something like, for instance, a John Orford, where you're in the conservative space, where your requirement is to deliver CPI plus 4. Your opportunities were here. The Rand was very weak. He bought a lot of money back and basically came down to around the 20% level. We did that across our range of funds. And currently, if you take something like the Balanced Fund or the Old Mutual Flexible Fund that I run, we're sitting at around 27, 28% offshore. And so we're still slightly tilted towards South Africa, but we have been increasing offshore as the Rand got strong again. So you've got these opportunities to bring assets back and forth. But also what's important is we're always thinking about what is the client objective. So for something like the Balanced Fund, our rough rule of thumb is that you should have about 35% offshore. So we're naturally inclined to go higher. For John, in the conservative space, where you're getting really good opportunities in fixed income in South Africa, it's a lower number, and therefore it's further away from the 30% because we align with those client objectives.
Thank you so much, Peter. My next question is going to go to Sibo. To what extent is there subjectivity in an ESG score view? For instance, are there different opinions on what is good and what is bad? And how do you decide who or what to subscribe to, as there's absolutely no consensus on anything?
Wow, what a question. And actually, as I was in my presentation, my objective was to talk about the various tensions in applying ESG, because it's easy to say it. Now, when you have to apply it, actually, and you get real about it, you find some difficulties. Now, in answering that specific question, of course, there's subjectivity. I mean, if you think about it from a global asset manager, if you are a global manager in the world, what they usually do, they're very prescriptive. So they will say, we don't like carbon, we don't like tobacco, and they exclude. But their indices are very, very small. So you can exclude, and it's very easy to be hard and fast in what it is that you're trying to do, because you've got a universe of over 16,000 shares. Now, when you bring it home to South Africa, actually, what are you going to exclude in a universe of maybe an investable number of shares of whatever, 60 to 80 that you can really invest in and out of? And so being exclusionary in South Africa actually is probably not a wise thing to do. So we don't exclude. So we have a team of analysts, and we also have an ESG team that also do their own analysis on companies. And in South Africa, we've found that the best strategy is actually, yes, to take a subjective view, to analyze the various factors, and then to score the various companies, and it'll come out in our portfolios like I described. So yes, we can score the ones we can price, we will score them on a price. But the other ones that we can't price, we will do various scenarios, and actually we'll score them what we call a theme, so the environment. And we will take all of that down and put it down, and then basically build portfolios with that in mind and size them appropriately. So yes, it is subjective. Now, at Old Mutual, we also do have quantitative funds which actually do technically score. And I think you can go into some of our fact sheets and read up how they score them. But again, it's not going to be perfect. It's evolutionary. And a company, in a market as small as South Africa, it's very, very complicated to actually be very scientific about it. So you have to take judgment calls.
Thank you for that, Sibo. It's wonderful to see the enthusiasm across the board for ESG. Andrew, Your presentation was really very insightful. And we've got a question for you. You mentioned that private sector corporations stepped in to fill the gap left by foreign discretionary investment and government income. What needs to be done to accelerate the recovery of FDI and government income?
Investment needs to recover. So private corporation savings made their way through financial intermediaries, through our financial institutions, through Old Mutual and others, into financing governments, meeting governments' debt issues and financing requirements, but did so largely because businesses stopped investing. So we had this huge curtailment of investment last year. That's got to get going again now as we go into 2021, 2022. And I think the presentation early in this program by Heimel is exactly right, that we're going to see stronger growth than expected in our economy over the year or two ahead, mainly because businesses will be investing, restocking, and that has a stimulatory multiplier effect through the economy, but obviously also is the circumstance that brings foreign investment back into our economy.
Thank you. That's quite encouraging, and it shows that we all have got a role to play. Vickers, what would be the triggers to signal that you do not want to be overexposed to longer-dated SA bonds?
Well, in our world of fixed interest, we've got two enemies: inflation and, of course, default. Hyperinflation clearly.
I thought you were going to say me.
Well, you like further down the line, Peter, but yes. So two things that we're sort of running actively with at the moment in terms of sort of monitoring risks are hyperinflation and, of course, default or restructure of debt. On both at the moment, still low probabilities. I think this time last year we were a lot more concerned about debt restructuring and things like that. But I mean, the big thing, and it's been mentioned before, is that SA, deep financial markets, most of our government debt is rand denominated. You're not going to default on that. Look at Argentina, Sri Lanka, and those countries. It's like all offshore. They just couldn't sort of deal with that. Our asset liability management in South Africa by National Treasury has always been really, really great. But yeah, so those things are monitored, and that will clearly sort of like make us think twice about investing in ultra long dated bonds. At the moment, lots of bad news still in the price. So the theme, okay, improving a bit, but with volatility, nothing moves in a straight line, lots of execution risk, but there's a lot of bad news in that price, and we need to acknowledge that there's basic rule, there's carry. You're going to miss that out. You're going to miss out on that. The curve is very steep. Cash is nowhere to be seen. So we need to sort of, can't get emotional about these things. We need to balance theme and price, and that's what we're doing at the moment.
Thanks, Vickers. Peter, Vickers mentioned some offshore destinations. Talk to us about China.
So the Chinese government has just basically nationalized their education industry. So this is the tutoring business. And they wiped out $100 billion worth of capital, mainly invested via the US and global funds. It's just an incredible show of power by the Chinese Communist Party. And it's basically saying politics over profits. Now that has had a big impact across everywhere, but most importantly in our market, into Naspers and Process, so SIBO's area. And so I think when we look at this, basically you will need to apply a discount to Chinese companies going forward in terms of what the government will do. We don't know. So it's up to policy, which is up to Xi. So it's unquantifiable. And in that case, you need to manage your risk and you need to manage your position size. Importantly, in terms of our portfolios, so if you think about the solutions, take, say, the Old Mutual Balance Fund run by Graham, it's had a rule of not more than 5% in a single position. So even though some of our competitors own 10% in Naspers, we didn't because we felt that was too much stock-specific risk. Because stuff can happen. And stuff has just happened in a big way. So we've already managed that. And in fact, we were underweight even against that. So all of our funds, I think, SIBO's Investors Fund is also underweight Naspers. But it's really around how do you create the risk management structure. And I think that gives us a bit more room to breathe when we're looking at these kind of shocks. And realistically, I think we'll understand the implications of this in a decade's time. This is going to impact how do we allocate money to emerging markets. Because emerging markets, more than 30% is in China, and China's share is growing. Well, not right now it isn't, because the market's just been slaughtered. But, I think I'm quite bearish about this. I think this is a major blow to the use of capital to develop China. It's going to reduce ROEs permanently and makes China much less investable.
Sure. And for that large economy, that is quite a statement. Sibo, if you want to add anything to that, you can. But my question from the floor is, has the Sasol business plan fundamentally changed? If not, is it likely to hit problems on the ESG front going forward? I mean,
Sasol's business model has been the same for you get some oil and you convert it into fuel, which we use, obviously, in driving around this country. So that business model is simple. Now, they try to diversify that by going to the US and building a very, very large plant that cost them a material amount of money, which obviously impacted their balance sheet in that they were producing, I suppose, fuel from gas, which is cleaner. Now, that's the only way that business model has changed. But actually, if you sit where we are, yes, obviously from an ESG perspective, carbon is something that the world is going away from. So we've probably reached peak carbon and are starting to decline from there. But Sasol, as an investment entity, if we look at it over its investment life, we don't think necessarily can fundamentally alter what it does as a business. The question is, though, is that from an investment perspective, it's not about whether the business model is changing. From us, we look at it and we say, wait a minute, the banks are charging, banks in terms of investing in carbon emissions, banks are saying, hey, wait, that's going to cost you more. So banks are pulling back. So capital, or the cost of capital, is rising to invest in dirty energy. Now, what that usually does is that it basically says, hey, investors require a higher return from those specific assets. So usually when you starve capital, what people then underestimate is that actually the returns then start increasing because all the peripheral players start disappearing. It's the same thing that happened in the tobacco industry in the late 90s, early 2000s. You said, well, you can't market, you can't promote, you can't do anything. Suddenly it created this oligopoly of 3 or 4 major players who then went on to grow profits astronomically. So it's never as simple as, that's bad, it's going to be a bad investment. It's all about the price you pay. And if you were paying the price you were paying for Sasol in this time last year, you've made an extraordinary amount of money. And so at this moment, we still see amazing value in Sasol, and our clients are exposed to that.
And obviously, our continuous engagement with Sasol management continues.
Yes.
Just a point on that.
Yeah.
Under ESG, it's not just the environment.
Yes.
It's also the society. So Sasol's impact into the South African economy in terms of value creation through the chain is a massive thing. So we can't just shut Sasol down.
Exactly. That's a very, very valid and good point.
Exactly. And also as an employer. Andrew, you spoke a lot about foreign investment. You spoke a lot about private sector participation, individual companies' participation. What else do you think can turn our growth story around? Is there anything else that you would like to highlight for us, apart from what you already mentioned?
Municipalities and the growth of cities and urbanization. In some ways, that for me is the big message of that story about US growth and productivity and living standards from the 1870s onwards. And of course, it's absolutely central to China's growth, is building cities that work, modernizing living conditions in the urban environment. Now, we've just had the Auditor General produce a report that tells us our municipal finances are completely shot. It's totally dysfunctional. There's a huge mess out there. That is a very misleading picture of our municipal finances. Our municipal environment is very diverse. You can't compare the metro with a small local or district municipality, and there are quite different structures of revenue and financing of our cities and municipalities. We absolutely need to strengthen the financial management and the revenue systems of our cities, particularly, but of the urban landscape as a whole. But it is not the case that our cities are in financial trouble. Our cities are awash with cash. And they're awash with cash partly because they underspend on their capital budgets hugely every year and have done for 20 years. They largely rely on transfers from the centre, transfers from the national budget to finance their infrastructure. They don't borrow. Municipalities have not borrowed in significant numbers for decades. Cities in China have debt on aggregate equivalent to something like 40% of China's GDP. Here it's 1%. Maybe 1.5%. So for the decade ahead, we're not just going to need to see a lot more private investment in housing and investment in business development, of course, associated with growth and employment creation, but we're also going to need to channel more finance to our cities. They will need revenue sources to sustain that. They'll need to strengthen their revenue systems. We might end up seeing some upticks over time in the rate space and rates costs of municipalities, the revenue sources of municipalities, but they absolutely need to borrow to invest for the long term. Otherwise cities become dangerous and horrible places to live in.
Well, that is a very, very encouraging view of our municipalities. The last question, and Vickers, I'm going to limit you to like a 30-second answer. Have global central banks' liquidity injection not impacted the fixed income playground, elevating risks?
Absolutely. It's something we need to consider. And that's what we're doing as well. I mean, I think that's where South Africa is different in a way. Yes, rates are low, lowest in decades, but it's not nearly as bad in that sense than in many of the advanced economies.
Thank you very much to our live panel members. It was wonderful to interact with you today. For all of you joining us this morning, we really appreciate you taking time out of your diaries to join us. We hope it added value to you and your clients. Some of the points that really stood out for me was the South African story, valuation and theme, some of the beautiful investment stories from Andrew, interesting developments in China, and how we have had funds that through decades have delivered growth for our clients. The content of this session will be available until the 28th of August, and you will be able to claim CPD points for those. Thank you again for joining us, and let us chase the rainbow after the storm. Thank you very much. Goodbye.